Shifts in the foreign exchange market. So a little bit of a review of the foreign exchange market. The foreign exchange rates are the rate at which one currency is traded for another. So when we're drawing the ForEX market on the y-axis, we're going to state one currency in the price of another. If the exchange rate increases for yen against the US dollar, then we say it has appreciated. And if the yen appreciates versus the US dollar, then that means that the US dollar must have depreciated against the yen. So here's a little bit of a review of the foreign exchange market graphing. Sometimes we might draw them side by side to kind of show that the relationships are connected between the two graphs, and that if one, the exchange rate goes up, then the other one we know the exchange rate is going to go down for some reason. So drawing them side by side can certainly help in terms of drawing these graphs and showing the changes, especially, for example, on an IB exam where you're asked about the foreign exchange market, you might as well draw both. So in the yen market, what you need to know is that yen go on the bottom in the yen market. So it's dollars per yen, since those are the two currencies we are showing the differences in. And then it's the quantity of yen. And then in the US dollar market, dollars goes on the bottom of the exchange rate, so yen per dollar. And then quantity of dollars on the x-axis. Supply and demand act as normal, and then we have the exchange rate and quantity ones. So demand shift factors for the foreign exchange, and all of these will increase the demand for that currency, is if there's increases in direct buying. Things like if there's more tourism coming to Japan, since we've said that the Japanese yen is appreciated. More tourism to Japan means greater demand for yen because you're going to need yen when you go over there. Or simply more demand for products from that country, so maybe the Japanese exports rise for whatever reason. More exports mean you're going to need/demand more yen, and so demand goes up for the yen. If the real interest rates rise in that country, in Japan, it's going to entice increased demand for financial assets, things like savings accounts, bonds, etc. And so to get those financial assets, investors are going to need Japanese yen, so demand rises. Now, the rise in real interest rate could be a lot of different things that cause that. So like the crowding out effect is going to raise interest rates, as well as contractionary monetary policy. So those are two other items that go along with that piece on rising the real interest rate. Or decreases in inflation and price level, because that makes the goods relatively less expensive. So if inflation is falling or inflation is negative, then the goods are going to become more affordable. And so the demand for yen will also increase. Now, we usually say that supply shift factors are reactionary to demand in the foreign exchange market. And the reason is that an increase in demand in yen, just like we've been stating, means that there's going to be an increase in supply in the US dollar or the other market. And the reason is that when you go to exchange currencies, you're supplying, as we demand more yen, we're supplying the market with more dollars in order to buy the yen. So now there's more supply of dollars available in the market. So demand in one market, supply in the other, and the arrows move in the same direction. So if demand goes down in one market, supply goes down in the other market. And again, that shows that appreciation, depreciation